Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to do a surface level overview of what I would call kind of rental real estate investing gone wrong. So I happened to come across this property. I was doing keyword searches on realtor.com, and one of the keywords I was using was motivated seller, right? So I happened to come across this property about that was selling for almost $600,000 in a brand new subdivision in well, relatively brand new subdivision in the northeast of Georgia, right? So maybe like an hour away from the city of Atlanta. And one of the things I was seeing is like, oh my goodness, like this is probably a rental real estate gone wrong. So I'm just going to tell you all the red flags that I see. And one of the things that caught my eye is just seeing, motivated seller. And usually when you see like a motivated seller, that's usually a source of good deals, but not all motivated sellers are good deals, or not all sellers who are motivated are able to provide a deal that you're able to buy as an investor. So it says motivated seller, the seller will contribute 3,500 in closing costs and the buyer will receive 2,500 in closing costs. Now, why would someone be motivated to sell, let's say, a property like this? Now, if you were an owner occupant, it might be a different story, but a property that you buy as an investor and as an owner occupant are two different things. Like if I bought this property for 500,000, whatever, and change, and this for my primary residence, and I'm making all my great memories here, I'm not going to just give it up, right? And unless there's a specific reason, like I don't know, I got into a car accident and I can't pay the mortgage anymore, I'm not going to let this beautiful property, it's 5 bed 4 baths, be sold, right? But as I was looking at the history, I was just looking at these red flags, right? Red flags. So I'm just going to kind of give you just kind of a the story of the property. And look, I've never talked to the property owner, but you can tell what the story of the property is just by looking at the property history. So, that stuff is public. So let me actually go down here. And so I think the property was built either around or 2021, or I mean late 2021, or um early, or I don't know, mid 2022 sometime. But as you can see here, it was listed at the late 2021, and then eventually the first time it got sold was the end of 2022, right? So it could have been in this phase that they were trying to sell when it was in construction. But the first sales price of that property was $569,000. Okay. And if you know anything about just real estate in general, if you buy and sell a property within a year and you don't get it at a significant discount, or you're selling at a very similar price, you're pretty much going to lose money. Okay. So let's say that you're this investor, right? And how do I know it's an investor? Because I look at the property tax records. It's an LLC in San Francisco. So I think what happened is that people from California, I'm from California myself, look at the real estate in San Francisco and think, oh my goodness, everything's so expensive here. So, oh my goodness, there's a 5 bed 4 bath house in small town Georgia for $500,000. That's a steal, because I get a 2 bedroom condo for San Francisco for like $1 million. So obviously that's a good deal. So I'm going to buy that at for $570,000, and I'm going to rent it out and I'm going to make a return on my money, right? I think that's what happened, because I saw the property tax records and it's LLC in San Francisco. So as you can see here, it's sold for $569,000. Now, if you look at the next page of the history of in Realtor.com, they listed it for rent 6 months after for $3,000. Now, I don't know about you, but would you pay for $500,000, $569,000, just to get $3,000 a month in rent? Right now, again, purchase price is everything, right? So if you got a $200,000 in home and you're getting $300,000 of rent, that's amazing. But if you buy a $500,000 home or $600,000 home and you're only getting $3,000 of rent, that's no bueno, right? But here's the other thing too. Here's the crazy thing. This is why I talk about the red flags, right? So here we have that it's listed for rent. And let me put this in red for $3,000. Then they do a price change, right? So the price change is for $2,945, and it seems like they couldn't get rented within a month and they gave up. Like that's what it looks like. and someone said, okay, screw this. I'm going to try. I had this property for 6 months. I don't know if anybody even lived in it. Yeah, but somebody, they had it for 6 months. Now they list it for rent. They do a price reduction. And, if you know anything about real estate, price reductions are kind of like death, right? Like you don't ever want to reduce the price and you don't want to get too greedy. What you want to do is be able to set it at a price that's fair and very average to what's comparable in the area. You set it too high, that's like the kiss of death. Okay. But let me go back here. Okay. So biggest red flag I see right here is they didn't rent it out until 6 months after. Okay. And then they gave up renting it after like 1 month. Right. And now, yeah. So, and again, my suspicion is that $3,000 of rent was not probably not typical for the area. And one of the things that you might not be aware of is that the rent price is not proportional to the purchase price. So for example, let's say I buy $1 million home in San Francisco, I may have to buy like pay like a $8,000 to $10,000 mortgage a month. If I just rented that property in San Francisco, the most they could probably charge me is like 4 or 5 grand, right? See what I'm saying? Like the rent price has nothing to do with like the price of ownership, or it's not directly proportional. But now the listing's been removed. They wanted to see maybe a couple thousand, $10,000 of appreciation, and then they listed. And again, as I said before, folks, the kiss of death in real estate is setting your price too high compared to the other houses in the area, whether it's rent or sales. Okay. So 595, price change, price change, price change. Again, this price change is the kiss of death. Okay. And so now we're at 572,000. Okay. 572,000. And we bought it for 569,000. So whatever's going on, this person or this LLC definitely lost money, because think about it. Like you take away 6% of the commission, and that's assuming that they even sell it at this price. That'd be really pathetic if they can't even sell it at the price that they bought it for, which means that the kind of, if that's happening, then the real estate market is kind of going down. But if they're going to be underwater, they're screwed, and they can't sell it anymore, because if they're going to sell it to a realtor, then they have to pay 6% commission. But let's just say that they resell it. They resell it for the exact price that they bought it for. Okay, so let me just do this: 569,900 times 0.06, and so they're going to have to give a $34,000 cut to the realtor, right? So that's kind of like the burden that most people don't think about when people sell their properties, and usually the seller's cost is about 8 to 9%. So let me just do 8 to 9%. So I'll just do 9% of 569,900. So again, the total seller's cost is 51,000, right? So that's why, like, if a property appreciates only 10 grand or whatever, and you try to sell it, not really that great of a deal, right? Not really that great of a deal. Okay, so as I said before, this property is a huge red flag just because I looked up the rent comparables, and if you don't know what that is, basically in single family homes, comparables are pretty much king. And what do I mean by that? Is that you want, in order to figure out what you can either get in rent or get as a, what someone is willing to buy your home for, you pretty much have to look at the other homes in the area. Now, it's not easy to find, let's say, rent comparables compared to sales comparables, but there are websites that kind of help you with that. So, for example, Rentometer. So I looked up this house on Rentometer, and it was saying something like, "Oh, the rent comparable is like 2,500." So the thing is, as I said before, if your price is too high, no one's going to rent from you. You know what I'm saying? Because they're going to look at the other houses and just go there that are at a lower price. And that's why, unless you own all the homes in the block, which may be possible in many cases, unless you own all the homes in the block, you can't raise the rents as much as you think you would if you're a landlord. You don't have that much power unless you own the whole block. Okay. So they try to rent it. They bought it for 570. They try to rent it. They failed at that, and then now it's just kiss of death. And again, they didn't even rent it, so I don't even know how I can say this is rental real estate gone wrong. But they didn't rent it. Okay, so it's like they plunked a lot of money. Maybe they were a doctor or something, and just so I'm just going to buy any real estate in Georgia, in small town that I think is a steal if I were buying in San Francisco, right? and they couldn't get it rented. Now they decide to sell it, and hence they're a quote motivated seller because they just bought property and didn't do anything with it. And folks, this is why I say that having too much money is kind of dangerous if you're doing real estate. You don't know what you're doing, because if you don't have any money and you're doing real estate investing, it's almost like a shield from doing bad deals. You know what I mean? Because like you have to get something under contract and try to sell it to other people if you're going to do wholesaling. But if you're doing like a no money, no credit strategy, you essentially have to have a really, really good deal that you sell to other people. But if you have too much money, and let's say you live in San Francisco and you're doing this type of deal and you're buying any old property and then just kind of losing money on it, that's why I say having too much money is dangerous when it comes to real estate. So, um, point of the story, buying from a motivated seller is usually good, but not always, right? So that's just an easy example of that. Why is that person motivated? Because sometimes a lot of investors, right, they buy real estate, have no idea what they're doing, and then they just kind of raise the price of it and hope that another sucker just buys their property because they didn't know what they're doing. I've seen that so many times on like real estate websites where somebody buys a property for like 20 grand. They don't even do the rehab, and then they want to resell it for like 40 or 50 or 60 or even 100. You know, they don't even do anything, right? Okay. So as I said before, I looked at tax record owners in LLC in San Francisco. So I'm assuming if you have an LLC in San Francisco and you're able to buy a $500,000 property, you probably have some nice chunk change to burn. Other things too, does it cash flow? You know, if you just know about the 1% rule, basically you want to get rents that are about like 1% of the purchase price. That's like a really ideal or good rental. And so, for example, if you buy a $500,000 property, you want $5,000 in rent, right? That'd be great. But we're not getting anywhere near that. In fact, we didn't get rent at all. We thought we were going to get 3,000 in a small town, but we couldn't get it, right? We couldn't even rent it at because the price is too high. And we had to look at the rent comparables. So I looked them on rentometer.com. It was about, again, 2,500. So that $3,000 rent mark was just a little bit too high. And as I said before, rents are not directly proportional to purchase price. Another thing that we want to ask is if we're paying out cash, is it a good rate of return, right? So let's just do this. So the way that we calculate our rate of return is basically the net operating income for the year divided by the purchase price. So let's just say that we'll say 2,500 is the net operating income, and then times 12, okay, divided by what's the purchase price? 570? Let's just take a look. But yeah, we'll do 570. 570,000, okay? And basically this is telling us we're making 5% of our money. Now, think about this. If we're buying real estate and we have to pay other people, so I'm actually like overestimating the income because I didn't take out like all the expenses, but if we're purchasing real estate and we're only making 5% of our money, and we have to manage tenants and do all this work, and we plunked in $570,000, let's just say, wouldn't it be better just to invest that money in like the I guess stock market? No, not stock market, like in a CD that's guaranteed to get me like 5%. So that's kind of something we also have to think. You know, another way of measuring is this a good deal or not? And so whoever bought this property from San Francisco should have just put it in a CD or something, right? I'm not giving financial advice, but that's what I think, because you know you're plunking down all this money. Had you rented it, you would be getting about 5% in the best scenario, and you ain't getting anything, right? And the other thing too, as I briefly mentioned, are we factoring costs to buy and sell real estate? You know, are we thinking about that 6% agent fee? So, you know, it looks like we're having equity and appreciation, but that 6% agent fee is going to wipe that out, right? So this is kind of like a surface level analysis of real estate. So I'm not like digging deep into numbers. In fact, that's like the most challenging part of real estate calculations, is that you don't have all the numbers. But if I just kind of look at like little things and hints and clues, I can just kind of tell myself a story. Folks, if you ever owned rental real estate and you ever had like 1 or 2 vacant months, it's like painful, you know, because you're paying the mortgage out of your own pocket if you do have it financed, but you want the tenant to pay it for you. So to kind of have a vacancy and shell out that money, I'm guessing this is what happened to this person. They listed for rent. Uh-oh, I waited 2 weeks and nobody's going to be able to rent it. Uh-oh, I should sell it now, and then I'm screwed, right? So again, don't be like this person. I don't know what their game plan is, but if I were in this position, I would just be freaking out and trying to tear out my hair and trying to sell it too. I mean, look, that's why he's probably motivated. The motive seller's motivated because we just saw that they're losing money, right? Beautiful house, though. I'd probably want to live it, but as an investment, no way, right? Because especially with single family homes, you want like the most common, typical cookie cutter house that mom and dad or Joe Blow can rent. You don't want a 5-bed, 4-bath house that's going to cost 3,000 to 5,000 a month to rent. You don't want that. Those types of renters, they can easily buy their own home, right? So you don't want those types of renters, and that's why you want your typical small cookie cutter house that actually is kind of lower in purchase price, but you get a decent rent out of. All right. So this is Crane Atlanta Mentorship. If you're interested in joining our group, go ahead and click the Google form link below. Please leave any comments, questions if you have any, and we will speak next time.